The real estate bubble, inflation, and government costs. How false wealth from real estate debt led to the current crisis in commodity inflation, foreclosures, and Wisconsin. In this short presentation, we hope to simply explain our country's current economic problems. Our economic mess has its basis in the false wealth of real estate. True wealth only comes from the productivity improvements a society produces. The false wealth from real estate debt and the real estate bubble has led to the current crisis in commodity inflation, foreclosures, and the Wisconsin budget. So where are we today? Or to put the question another way, what do home foreclosures, the protests in Wisconsin, and the unrest in the Middle East have in common? Thousands of pages have been written on the issues here, but I will try to explain the economy and the relationship in about a dozen slides. The Dow Jones Industrial Average has historically been a key measure of wealth in our country. It is a simple average of the stock market value of 30 big companies. And how do we measure their value? Through stock prices, investors measure how effective the companies are in using capital and labor to earn profits by producing products that society wants to buy to make life easier and more enjoyable. Investors pay more for companies that produce a lot without much input costs. So, we measure a ratio, with the numerator being products people want through revenue and profit generated, and the denominator being capital and labor, a productivity ratio. The Dow Jones Index is a wealth measure and a productivity measure at the same time. Which brings us to our next slide. Increases in productivity cause increases in wealth. Human civilization really didn't increase wealth at all from Roman times until the beginning of the 19th century, and then it exploded. Here are 7 examples in transportation, production, and manufacturing. Major moves in the Dow Jones Index and in society's wealth have taken place around major changes in productivity. The companies that increased their productivity, increasing the country's wealth, were given higher values by investors in the stock market. In the 1980s and 1990s, this country saw a major increase in productivity, this time caused by technology. The improvements to society were as great as the Industrial Revolution. One interesting measure was the cost to store a gigabyte of information digitally. It dropped from $230,000 in 1980, the cost of a house, to $30 in the year 2000, and now costs about 25 cents. The stock market reflected these improvements as its total value rose over $13 trillion in just 10 years during the 1990s. Technology-led improvements drove this, and productivity and wealth spread throughout the economy. Real estate debt rose only modestly. America was at its best. The dollar was strong, inflation was low, and the standard of living was increasing. Then, the technology stock bubble burst, and stocks crashed in 2000. The valuations of the companies declined, but the productivity from the products the companies produced continued to contribute to society. The internet kept growing, wireless phone services kept growing, and the fiber optic cable laid was being utilized more. So we just had to accept slightly lower stated wealth as a country, and we would have continued the productivity trends. Instead, using easy money from the Federal Reserve, Wall Street investment banks said no, don't worry about tech stocks falling. We can create wealth elsewhere. We can create wealth in real estate developments, more housing, and more shopping malls. The financial markets, with the help of Fed and federal government policies, turned on the mortgage machine. As a nation, we created $8.5 trillion in mortgage debt, backed by new residential and commercial real estate developments. Bankers got bonuses not by taking productive, innovative new companies public, but by repackaging and selling mortgage debt. $8.5 trillion in new real estate debt was just a staggering misallocation of capital. Real estate developments do not improve productivity. No one gets anywhere faster or cheaper, or communicates more easily, or does research more efficiently. More real estate is just more assets, more of the denominator. It can actually reduce productivity because it requires additional expenses that don't produce more benefits. We built way too much of this stuff. We were building 3 million houses a year when only 1 million were needed. We doubled retail shopping space, while retail sales increased only 12%. So like anything else we produced too much of, real estate prices eventually fell. Since most real estate loans had very low down payments, the false wealth from the real estate bubble quickly flipped into deep losses, underwater debt, foreclosures, and defaults. But while we were enjoying greater perceived real estate wealth, our federal and local governments continued to spend as if we were creating real wealth. This can be seen in this chart, a very important chart. Total government spending per person, adjusted for inflation, is up 35% since the year 2000. Median household income is down 5%, and house prices are back to 2001 levels. Our government was spending as if we were wealthier, when in reality we were not. For the first time in our history, government jobs pay substantially more than private sector jobs, with generous fringe benefits on top. The Heritage Foundation estimates compensation for a job in the public sector is 30 to 40% more than its equivalent in the private sector. So, the misallocation of capital through the real estate bubble has now led to a misallocation of labor costs. The protests in Wisconsin are related to this. The governor wants to get state workers' costs in line with the private sector, and the government unions are fighting it. And it's not just Wisconsin. It's a problem throughout the nation on all levels. It will be a nasty fight to get our nation's labor costs reallocated properly, to bring government spending and labor costs down in line with the rest of the economy. But that is just one side of the problem. The Fed badly wants to make real estate values rise to prop up the banks. Many small and medium-sized banks have 40% or more of their assets in residential and commercial real estate loans that are at a high risk of default. The Fed is taking unprecedented actions to try and prop up real estate. They have reduced the Fed funds rate to 0%, so there is no cost to the banks to borrow money. Clearly not a productivity-producing program. There are no costs to banks for sitting on the Fed's cash or on your cash. Cash is just sitting in the banks, not producing. In addition, the Fed has almost tripled its balance sheet for these quantitative easing programs. The first program, QE1, bought $1.5 trillion of mortgage-backed securities. The current one, QE2, is buying $600 billion of government treasuries. All of these Fed actions are trying to support bad assets, assets that do not contribute to productivity, excess residential and commercial real estate. But by providing cheap money to support these bad assets, the Fed is also enabling cheap money to speculate in neutral assets, commodities. Like real estate, commodities don't increase productivity, but unlike real estate, they cost little to hold. They have no heating costs, no real estate taxes, etc. So rather than buying real estate, as the Fed would hope, speculators are using cheap money to buy commodities like oil, copper, corn, wheat, and so on. Since developing countries spend more of their GDP on these inflating commodities, they are seeing much more overall inflation than we are. Egypt has 18% inflation, Iran 25%. This inflation is sparking global unrest, which we see every night on the news. So, to summarize, the policies of the Fed and federal government after the tech bubble burst caused a Wall Street-led, debt-financed asset bubble in real estate, creating the illusion of wealth. The false wealth encouraged our local, state, and federal governments to spend beyond their means, and we now have a day of reckoning in government spending. Secondly, the Fed tried to prop up real estate prices, and banks that hold too many real estate loans with ultra-low interest rates, which also ignited speculation in commodities like food and oil, causing global inflation and unrest. So the next time you see a dead mall or a foreclosed house, you can relate it to the spending mess in Wisconsin or your state, and to the riots in the Middle East.